What's good, YouTube? It's your boy Ipboyles back again on this YouTube channel. My name is Ipboyles. I'm a day trader and also a technical analysis trader. So in this video, I'm going to teach you guys how you can trade supply and demand because my strategy is based on smart money, supply and demand. So in times of supply and demand, I can teach you supply and demand in depth and teach you all you need to know about this trading strategy called supply and demand. So let's get to the video. If you're watching this video right now, all you can do is to just subscribe. If you're a new beginner, this video is going to help you a lot in times of technical issues in trading or technical analysis or strategy. So this video is based on supply and demand. First of all, I'm going to teach you you need to first know what is supply and demand and how supply and demand works in trading. So that's what I'm going to have to teach you in this video. First of all, supply and demand are reversal areas in the market where banks place orders, where they place limits, where you will see impressive moves. So that is supply and demand. So how do you trade supply and demand when it comes in times of strategy? Supply and demand work in all market conditions. It can work in ranging markets. It can also work in trending market, whether it's uptrend or it's down trading market. First of all, if you want to hear about supply and demand, they don't know what is supply and demand, how to draw it, candlesticks that represent supply and demand trading, and also how to map it. First of all, before I start teaching how to map out this supply and demand candlesticks, first of all, you need to know that supply and demand is a very cool strategy. You don't overcomplicate it when it comes to trading it. All you need to do is to just know the basic things you need to know. Keep it simple, understand? Reversal signal candlestick. If you have read about candlestick bible, check this video description. I will be posting the link to download the candlestick bible. So these candlesticks are candlesticks whereby when you identify them in a higher time frame like 4 hours, 1 hour and 30 minutes, it can give you a potential of signal to buy or sell. So we also use this concept in supply and demand because these candlesticks represent signals in the market. When you see this candlesticks, it's a signal to buy or sell. Or you map out supply and demand, it really works on a higher time frame like from daily 4 hours, 1 hour and 30 minutes. So if you find out a kind of candlestick, reversal candlestick on this kind of time frame, it will have a higher possibility for you to win that trade. And again, is that you follow supply and demand. Supply and demand works with structure, so you get to know about structure. Once you know structure, then you get to know how to draw supply and demand in higher time frame and in also lower time frame top down analysis. So first of all, let me teach you guys how to trade it and how to map it. So if you watch this candlestick, this selling candlestick, and also this buying candlestick, so once you see this kind of impressive candlesticks and this kind of impressive candlestick, it represents that the banks are in the market. Understand? These are where orders are being fulfilled. Understand? So all you need to do is to look for the reversal candlestick up there, from the up to the down. So if you watch this, you see that this is a reversal candlestick. So I have to map it and let it be. So always supply and demand is very effective when it's still fresh. What do I mean by when it's still fresh? Like when the market, like when candlestick hasn't touched it, when any candle hasn't penetrated it or mitigate it. So this is called supply zone. So also we have two types of supply and demand zone. We have reversal zone. The reversal zone is called the change of character zone, whereby you trade above the higher highs and higher low. at the higher highs and higher lows, whereby the market reverse. So what do I mean by this? So what I mean by this is that the market is going up, higher highs, higher low, higher highs. Understand? Then after that, the market go more high, breaking the previous high. Then it has to break this low. So once price break this low, then you need to look for the candle. This is the breaker block. We call this the breaker block. So after this breaker block, then there should be a reversal candlestick that mitigated this high. So after that, that's when you'll be drawing out your zone from the reversal. You have to look for the reversal points of confluence. Then once you find the reversal point of confluence, then you draw it and let it be. Then you have to map out the breaker block. The breaker block is whereby candlestick, the previous demand zone will be mitigated. You need to wait for candlestick to come into that zone with compression, with a gradual process. It shouldn't be fast. Understand? It shouldn't be fast. It should come with compression, because the previous impressive candle has already happened, shift, or you can call it change of character. Then once it starts to the zone, then it will reject, or it will give you it will print a new impressive move. So this is called a reversal supply zone. And at the previous low, let's say we invert this chart. If we invert this chart, it will be a demand reversal zone. So this is also what I mean. So it's now a downtrend. It's now a downtrend reversal going up. The second one is called the continuational pattern, the continuational supply and demand zone. So what is called the continuational supply and demand zone is called the S&D, supply and demand flip zone. The supply and demand flip zone is whereby price intends to reverse. Understand? Let's say price is still going downtrend. It's called a continuational pattern. So this, after breaking this block, there should be something what we call a demand zone. Understand? That we didn't respect. So it's called a kind of called flip zone, or you can call it continuational. So whereby the price comes back into the zone. The price might come back into the zone, then it will react from the zone. Then after reacting from the zone, so it has to reject once it reacts from the zone. So this is called a continuational pattern for a demand. A demand becomes supply. You can call it support becomes resistance, or you can call it demand becomes supply. So this is a very simple concept. So now I want to teach you guys how to draw this supply and demand zone. So first of all, if you watch this move, you see that we have a downtrend market structure. This is a downtrend market structure. This is a low, and here is a high, low, and this high couldn't break the previous high. So after from there, the market gave a new low from there. So after that, the market gave us a new higher low, then still going down. So this is what we call a structure. So what is the structure in India? What do you mean by structure in India is that the market is still breaking the previous low. So these are this low. So it's called the previous low, which is the structure of this move. So this is still the structure. Once the market breaks structure, then you have to wait for it to return before you still sell. So how do you find a setup from this kind of market move? So if you watch here, you see that after this candlestick was formed and this impressive move was formed, we found that we have a good opportunity to continue a sell. But what you need to see is that you need to look for a zone that will be holding. So we have this supply and demand flip zone, which is called a continuational flip zone because this is an engulfing candlestick, the red candlestick and the heavy blue candlestick. So this is an engulfing candlestick. All you need to do is to just the chat just went off due to bad network connection. So how did I draw this? I drew this. Everybody has its own ways of drawing supply and demand. So I do draw my supply and demand from the opening, from the, let's say this candle, from the close of the red candle stick to the wick. So it depends on the type of reversal candlestick. You always extend it to the wick. So why did I draw this type of reversal? It should have been something like this, from the opening of this candlestick to the wick. So it was a demand zone. Then after that, the market didn't respect it, so it have to now be from the closure of the red candlestick, or you call it black candlestick because my chart is kind of customized. I am using black candlestick as red and using blue candlestick as green. So for my psychological perspective, that's why I'm changing. That's why I don't use red and green candlestick. So everything in this market has a reason. So just know what works for you. So after that, we see that market stopped. We were waiting for market to come back at this supply zone. So later we found out that the market dropped, break this previous structure. Then we have this zone that was left here. So we had nothing to do is than to wait for market to come here or reject from here. So after that, the market, you can see that the market rejected from here. Then after that, we then see a new bank footprint. We call it bank footprint. 2 consecutive impressive move bearish candlestick. So after that, you can see that the market created a shooting star. This is a bearish shooting star, so that was formed here. So all I need to do is to, since the market has broken structure and also break the minor structure here, so all I need to do is to draw it from the opening of the blue candlestick to the wick. So this is now our current supply zone. So how do you trade from that supply zone? So if you watch this zone, you see that this zone is a lot big, but still the market tapped it and dropped. So how are you going to get some move from this? Before you get some move, you must consider liquidity as a point of confluence. We have types, but in this lesson I'm just going to highlight liquidity cost. Liquidity is a form of inducement, or where sellers or buyers stop loss are being placed. So how do I attempt to know that this is a liquidity? Is that we see that this is also a reversal candlestick. It's called a Harami candle. So this is kind of a fake signal that some people want to also trade from, because if you don't understand supply and demand in depth, you'll be trading from a wrong zone. You need to look for a structure and also work with Fibonacci. So some people want to trade from here due to they think that this is kind of a zone and it's also a high. So some people want to trade from here. So when you see this kind of setup, you know that something that the banks normally do. They do manipulate new people in the game. You understand? Liquidity concept is a kind of concept that no one is above it. Even new traders are being manipulated sometimes, and also professional traders are also being manipulated sometimes in the market. So nobody is above liquidity and no strategy is above liquidity. So all you get to know is to just know the right zones for you to trade from. And then once you know the right zone for you to trade from, always use proper risk management on your trading. So that's what will take you a long way in this game. So once we come to the 15 minutes time frame, you'll see that we still have the zone is still fresh. You understand? It have not been tested with this week, even though this is 15 minutes time frame. So after this inducement, then how do I capitalize from this move? I don't just place my short. Let's say I don't just place my short position once the market taps into it. All I do is just I wait for a little confirmation before I can trade from that zone. So if you check from the entry point to the week, you see that that's about 20 pips. So it's also good for people that is risking 20 pip or 30 pip in per trading. So for me, my strategy, I don't use 20 pip stop loss. I use 10 pip stop loss and 15 pip stop loss. So what do I do as a trader is that I look for more confirmation to trade this type of setup, because I already know that the market has mitigated this high already. So all I need to know is to just look for a confluence that show me that market is still going to go down, which I see that the market also created this sort of liquidity, so which is called a two equal lows. So it's a kind of liquidity in the market. So this liquidity in the market is the previous high, whereby the market has created this Asian range. Like, let me say, when I open my kill zone, you see that this Asian range is my kill zone, whereby the market gives us this low and this high. Then we want market to trade above this zone before we can start selling. So the market want to sell, it will first buy, you understand? So it first buy and it gets the Asian range high or the Asian range low, then the market will sell. If the market want to buy, it will must make sure that your Asian range is no more than 30 pips max, understand? It's no more than the lows and high is no more than 30 pips, understand? So the market get to mitigate those lows and swap liquidity, then touch the main zone. So what am I going to do? How do I capitalize on this move? I told you that I always trade with two confirmation setup. I don't trade with other confirmation. I trade with my 3D drive. So my 3D drive is something like, I will also give you a kind of new lesson about 3D drive. 3D drive is a very interesting pattern that everybody need to learn. 3D drive is a kind of inducement pattern where markets give you a 3 consecutive touches: first touch, second touch, and third touch. So before we trade those 3D drive, I have a way that I trade my own 3D drive. So I want to make sure that the market also give me a fake signal in the second touch, a kind of fake signal, 15 minutes confirmation choke. So this kind of confirmation is kind of where markets touch the zone. So you just tip the zone and then break the previous low. So from here, people want to sell early to the markets. So what do I do is that I want to see that market has break the previous low, then create a zone here. So people will place order from here. Let's say people get to place order from here. So you place order from here, then put a 10 pip stop loss. They placed order here, put a 10 pip stop loss, or some will put their stop loss above this week about 5 pip. So this is 5 pip stop loss. So what market will do is that they'll come into that zone. They will try to give you a rejection, a small move. Sometimes it will drop, then it will come back and push at that zone. It will hit your stop loss, then touch to the touch. So what do I do is that I go to my 15 minutes, to my 5 minutes, Once I go to my 5 minutes, I need to look for something good. If I didn't see a good confirmation of 5 minutes, then I know that I'll be waiting more and more to see if the market will give me something that that I will do something that I want. So if the market didn't do what I like, I'll leave that setup. So no choke, no entry, no confirmation, no 3D drive, no entry. So that's for me and how I trade. So everybody has its own way of trading in this forex industry. So when the market gets into after the market, I have to wait for the market to induce this high, the second touch, then give me this third touch, then give me this low, then still induce the previous high it created, then after that it drop and break the final this low, this 5 minutes low. So after that, after breaking it, I don't know if you guys are seeing this, so I have to change the color. Okay, let me just make it something line. Let me just make it a line chart. Okay, so once you see that the market tips and break this previous low, then I have to look for a 5 minutes order block. So since the market this is the final phase of this zone. So inside a zone there will also be a zone. So you don't just enter once the market taps into a supply zone. You need to wait for 5 minutes or 15 minutes. That's why on my Telegram, whenever I give signal or trading setup, I always say no choke, no entry. Please wait for a confirmation before you trade from any zone you want to do. So this is a kind of confirmation of this trade. So that will make me not to risk about 20 pips. So I'll be going down to put my stop loss above this zone, about 5 pips stop loss. So it depends on the type of broker you use. If your broker is the kind of broker that has high spread, their spread is always high in times of selling, so you can make your stop loss 10 pip. Let's say you can make your stop loss 10 pip here, then you target on this trade. So I have to go to my 15 minutes back. So your first take profit should be on the first week low, which is about that's about 32 pips. So this should be your first TP, and then the maximum TP has to be on 60 pips. So you take profit around this low, on this low, then after this taking profit on this low, then your second take profit should be 60 pips. So don't take more than 60 pips. Depend on the type of pay, on the type of pay that you are trading in. Euro USD, I always take 60 pip from the market, understand? So don't be greedy, just stay consistent, and see you guys on the next video.